If I invest in an ETF savings plan for 15 years, nothing can really go wrong. Does that sound familiar? It's a common belief among investors, almost like a guarantee for success. But I have to be honest with you, it's not that simple. In this video, we'll dive deep into how safe an ETF savings plan really is, what the famous 15-year rule actually means, and why you shouldn't blindly trust average returns. We'll compare savings plans with lump sum investments, look at real historical data, and clear up a big misunderstanding about the cost-average effect. Let's get started. So, where does this 15-year rule even come from? For decades, a rule of thumb in finance has been that anyone who invests globally in stocks for at least 15 years has historically never lost money. This idea is mostly based on the performance of the MSCI World Index since the 1970s. This index is broadly diversified, covering over 1,400 companies from developed countries. And yes, looking back, the average return across all 15-year periods was about 7 to 8% per year. But here's the catch. That's just an average. It doesn't mean every single investor got that result. Your personal return depends heavily on when you start and when you sell. For instance, if you had invested right before the dot-com bubble burst in 2000, you would have had to wait until 2013 just to break even. On the flip side, those who started investing after the 2008 financial crisis enjoyed double-digit annual returns. So, the 15-year rule isn't a magic shield, it's a statistical observation from the past. To really understand an investment's stability, we need to look at what are called rolling returns. Imagine we calculate every possible 15-year return for the MSCI World since 1970. We do look at 1970 to 1985. Then 1971 to 1986, 1972 to 1987, and so on. This shows us how much the results can vary depending on your start date. The data reveals something interesting. While the average 15-year return was around 8% per year, the range was huge. In the best 15-year period, investors saw a return of over 14% annually, but in the worst period, the return was just 1.3% per year. That's barely beating inflation. This shows that even over 15 years, there's still risk, especially if your timing is unlucky and you start investing just before a major market crash. This brings us to a classic debate: lump sum versus an ETF savings plan. Should you invest €10,000 all at once, or put in €200 every month? Both strategies are valid, but they lead to very different outcomes. With a lump sum, all your money is in the market from day one, maximizing its time to benefit from compound growth. The risk, of course, is bad timing. If the market crashes right after you invest, it hurts. With a savings plan, you invest gradually. This reduces the risk of putting all your money in at the worst possible moment. Psychologically, it feels much more comfortable. But here's the thing, most of your capital is invested later on, so it has less time to grow. Many people think savings plans are safer, but that's not entirely true. They are mainly more convenient and less stressful. Let's make this concrete with an example. Imagine a savings plan on the MSCI World, investing €200 a month starting back in 1970. What would have happened? Over a 5-year period, the results are wild. In the worst 5 years, now for our benchmark, 15 years, with €200 a month, you'd invest a total of €36,000. In the best 15-year period, from 1974 to 1989, your investment would have grown to an incredible €75,000. But here's the shocker. In the worst 15-year period, from 1994 to 2009, you would have ended up with just €28,800. That's an actual loss, even after 15 years of diligent saving. Surprisingly, a lump sum investment over that same worst-case period would have still earned a small positive return. So yes, a savings plan can sometimes be riskier than a lump sum. Why can a savings plan be riskier? It sounds totally counterintuitive, right? It's because, on average, your money is invested for a shorter time. If you invest €36,000 over 15 years, only the very first payment is in the market for the full 15 years. The last payment is only invested for a month. On average, your money is only in the market for about half the total time. If a crash happens late in your investment period, it hits a much larger chunk of your accumulated capital. With a lump sum, all your money is invested early, giving it more time to recover from downturns. This doesn't make savings plans bad, but it proves they aren't automatically the safe option. So, does this mean we should give up? Not at all. The magic happens when we extend the timeline. Let's look at 20, 25, and 30-year periods. Over 20 years, the worst-case scenario for a savings plan was a tiny gain of 0.3% per year, while the best was a 15% annual return. Over 25 years, the worst case improves to a 2% annual return. And over 30 years, the worst historical outcome was a solid 5% return per year, while the best was 13%. The pattern is crystal clear. The longer your investment horizon, the more stable your returns become. The gap between the best and worst outcomes shrinks over time. This is a classic financial principle called regression to the mean. Now, let's talk about a popular selling point for savings plans, the cost average effect. The idea is that by investing a fixed amount regularly, you automatically buy more shares when prices are low and fewer when they're high. This supposedly gives you a better average purchase price. It sounds logical, but there's a problem. This effect really only provides a significant advantage when markets are moving sideways for a long time. Historically, markets tend to trend upwards. So, investing as much as you can as early as you can usually leads to higher returns. The cost average effect is more of a psychological comfort blanket that reduces volatility. not a secret formula for boosting profits. What does all of this mean for you in practice? If you're using a savings plan, you need to think truly long-term. Don't just plan for 15 years. Aim for 20, 25, or even 30 years. Remember that each monthly contribution has its own investment horizon. Your first payment might be invested for 30 years, but your last one might only be in the market for a few months. This is why having a genuinely long-term mindset is so crucial to achieving those attractive average returns we always hear about. There are two more crucial factors we can't ignore: inflation and taxes. All the historical returns we've discussed are nominal, meaning they don't account for the rising cost of living. If inflation is 2 to 3% per year, a nominal 8% return is really a 5 to 6% real return in terms of purchasing power. That's still great, but it shows that long-term investing isn't just about growing your money, it's about preserving its value. As for taxes, you will eventually pay capital gains tax when you sell. However, the exact impact is individual and often managed by using annual tax allowances, especially in retirement. That's why historical data is usually shown before taxes. Let's be realistic about investor behavior. Very few people have a large lump sum ready to invest all at once. An ETF savings plan is a fantastic tool that fits into our everyday lives, allowing us to build wealth gradually from our income. The key is managing your expectations. Don't fall for the myth that 15 years equals guaranteed safety. As you get closer to your financial goal, like retirement, remember that your most recent contributions are the riskiest because they've had the least time to grow. It can be wise to reduce or stop your savings plan a few years before you need the money to protect it from a sudden downturn. At the same time, you'll likely withdraw your funds gradually in retirement, not all at once. This naturally extends your investment horizon even further, which reduces your risk. Ultimately, it all boils down to one simple truth: time in the market beats timing the market. Historically, investors who stayed in the market for 20 or 30 years have always seen positive returns. Short-term ups and downs will happen, but over decades they become little more than blips on a chart. An ETF savings plan isn't a tool to eliminate risk. It's a disciplined and powerful method to participate in the long-term growth of the global economy. So, to wrap up, 15 years is a guideline, not a guarantee. Lump sum investments often lead to higher returns but come with more timing risk. Savings plans are easier to stick with psychologically, but aren't automatically safer. What truly matters is your consistency and your patience. If you found this breakdown helpful, please give this video a thumbs up and subscribe for more clear, no-nonsense insights on investing and personal finance. Remember, patience is the most valuable currency you have as an investor. Thanks for watching, and I'll see you in the next video.